In this week's video, we'll examine the question, what do market wizards have to say about investing in 2016? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. These classic investment books contain interviews with or profiles about some of the most outstanding money managers and traders of our time. Since their core investing tenets are timeless, we can apply many of them to the present day. The first quote we'll review is from John W. Henry. It comes from Covell's Trend Following book. In the quotes that follow, we'll have the names and the source underneath the quotes. If you want to do some research on your own regarding the books and or the money managers, you can do that. Henry, one of our basic philosophical tendencies is that change is constant, change is random, and trends will reappear if we go through a period of non-trending markets. It's only a precursor to future trends. And we feel if there's an extended period of non-trending markets, this really does set up a base for very dynamic trends in the future. We know that the three major indices in the United States, along with numerous asset classes, have basically been trendless or non-trending markets, some for several years. The Nasdaq's box here goes all the way back to 2014. History tells us that basing periods or non-trending periods are often followed by very dynamic periods once either a bullish breakout or bearish breakdown occurs. In the case of 2016 for the Nasdaq, we were inside the base. We've broken out to the upside. I knew I could not predict anything, and that is why we decided to follow trends. And that is why we've been so successful. We simply follow trends, no matter how ridiculous those trends appear to be at the beginning, and no matter how extended or how irrational they seem to be at the end. We follow trends. There are numerous ways to follow and monitor trends. Weekly trend lines is one possible method. This is SPY here. This is obviously a downtrend where our faster moving average blue is below red and the slopes of both of them are down. How do the exact same weekly moving averages look today? The answer is quite a bit better. Instead of having blue on the bottom, blue is on top. And instead of having the slopes of both of the moving averages being negative as they are here, they're clearly positive intraday on Friday, August 12th, 2016. Therefore, given the data that we have in hand, SPY remains in a bullish uptrend. If you take emotion, would be, could be, should be out of it and look at what is and quantify it, I think you have a big advantage over most human beings. Clients and longtime viewers of these weekly videos know that is exactly what the CCM market model does. It takes an enormous amount of data and quantifies it. We take things down to a single number that we can compare to historical numbers to get a very good idea about the health of the market. For example, these are weekly trends. This is TLT or long-term treasury bonds. This is obviously a downtrend in 2009. It's the bearish moving average crossover here. Gold in 2013. This is also not a favorable period to own GLD from a probability perspective. We have that full bore bearish look, at least when we're looking at the weekly moving averages. How do these charts look in the present day? The answer is quite a bit better. These are the same weekly moving averages. We purposely chose two weekly moving averages that are not used by the CCM market model. We're using these weekly moving averages for illustrative purposes only. We can quantify the look of this here, and the numbers that are coming out of the model presently as of August 12th for both bonds, TLT, and gold, GLD, are favorable. This is a Bloomberg article dated December 28, 2015, recapping what was a frustrating 2015 for trend-following models. 2015 was deemed the year that nothing worked. Stocks, bonds, cash go nowhere. The early stages of 2016 were also trendless. We had a sharp drop and then a sharp reversal where price really went nowhere between the 2 points here early in 2016. What do the market wizards have to say about these trendless and difficult periods? When we have had bad trading periods, it is really not one market that does it. In those situations, and he's referring to the bad situations, almost all the markets are going sideways and making lots of false breakouts. The point of the exercise here, not particularly surprising that 2015 and early 2016 did not work out very well for trend-following methods. However, now that we have the breakouts that have not turned back into false breakouts, right now we have successful breakouts, things may be improving. Given this headline from June 27th of 2016, Brexit turmoil deepens, Dow down nearly 900 points in 2 days. Again, this is June 27th. Given this headline, it may be difficult to believe that we eventually broke out to new highs on all 3 major indexes in the United States. What do the market wizards have to say about situations such as this sharp and unexpected reversal? There is another point that I think is as important. You should expect the unexpected in this business. Now that all 3 major indices have successfully broken out of those multiple year consolidation boxes, and as of this video, they are still holding those breakouts, let's cover a little bit about the where do we go from here. When we're inside of those boxes, trend following is not particularly effective. Now that we're outside of the box, we want to move back to our core strategy and our core rules, which means the whipsaw rules are currently not in the equation. This is the S&P 500 here. This is 1999 where my cursor is. This is the low here in 2002, 2003 in the S&P. And this is a rally here into 2006. What do the market wizards have to say about volatility and capturing trends? I think to be viable, a trend-following system has to be medium to longer term. How do we follow a downtrend like this? And how do we stay with an uptrend like this within the context of this volatility? Obviously, there's numerous ways to do it from a mathematical perspective. One of them is to add some moving averages into the equation. Our goal during bullish periods is to classify this volatility here during the uptrend as volatility to ignore within the context of an ongoing and rising trend. We start to get a switch here, and then we flip over to volatility to ignore is now the counter trend rallies within the context of an ongoing and well-defined downtrend. Then we flip back here, where this now longer term is your volatility to ignore within the context of an ongoing and well-established uptrend. How can the moving averages help us do that? And how can the math and the model help us do that? If we remove volatile price from the equation, we know a full-bore bullish look is when blue is above red and the slopes are up. You can see during the bullish period, typically that's what we see. Blue is above red, and for the most part, the slopes are up. Contrast that with the bearish period, where blue is below red for the majority of the time, and the slopes of the moving averages are down. Now let's contrast the look of the downtrend with the look of the new uptrend. Instead of blue being on the bottom, blue has flipped back on top, and for the most part, it stays on there. Remember, these are weekly moving averages, and we purposely picked 2 that the model does not use. We're using these for illustrative purposes only. The key takeaway for us is you have to hold your positions during bullish trends, or you have to hold your conservative positions during bearish trends, which means now that we're out of those boxes, we have to be thinking longer term, and we have to mentally prepare for periods of volatility to ignore within the context of what may be an ongoing uptrend. It's much easier to get an idea of what to do looking at the moving averages relative to volatile price. If you go back and reread the two Market Wizards books and Covell's trend following book, you will be reminded of a theme that is reoccurring in all three volumes. The most important thing is to have a method for staying with your winners and getting rid of your losers. The math can help us. Very difficult to decide what to do here. For illustrative purposes, if blue is above red, we can decide to stay with our winners and ride out the volatility. If blue drops below red in a hypothetical example, we could use that as a criteria to get rid of a loser. The math and the hard evidence, not emotions, CNBC or the front page of the Wall Street Journal or the Fed, they can't help us make that decision rationally. The math can help us make rational and prudent decisions. The basic concept from another book, The Wisdom of Crowds, is one of the reasons why monitoring the market is helpful in terms of managing winners and losers from The Wisdom of Crowds. The argument of this book is that chasing the expert is a mistake, and a costly one at that. We should stop hunting and ask the crowd instead. Chances are it knows. In short, this is a description of the wisdom of crowds. The crowd had us in a trading range here. What is the wisdom of the crowd telling us now? We may not fully understand the why behind it, but the net aggregate opinion of the crowd, or of all market participants, or everyone that impacts the financial markets, has now shifted in such a way that we were able to break out of this long-term consolidation box. The longer we stay above the box, the more meaningful it becomes. When we closed on August 12th, we were still above the box, and the breakouts were holding in a successful manner. Why is it so difficult to let your winners ride? Going back to Market Wizards, they, meaning the general public or investors, tend to confuse short-term volatility with long-term risk. The longer the time period, the lower the risk of holding equities, and that also applies to any risk asset. People focus too much on the short term, week to week, month to month price changes, and don't pay enough attention to the long-term potential. This is the short-term volatility here. The way that we can focus on the long-term potential is to leverage the math, the model, the rules, and the hard evidence. It's much easier to stay with this look than it is this look. Market Wizards, the secret is being as short-term or as long-term as you can stand depending on your trading style. One of the things that's clearly apparent when you read these books is your way, and that would include the CCM way, is far from the only way to approach the markets. There are numerous ways to skin the risk management cat. However, they all share some very important tenets of success. If we look at volatility, it puts this quote into some context. This is obviously a bullish trend here. How much you can stand is really the drawdowns and the volatility. You have to be able to hold your positions and let your account and your account balance swing during inevitable bouts of volatility or counter trends within the context of a rising trend. And that's exactly what the math, the model, and the rules and the discipline helps us achieve. When we look at a weekly chart of the S&P 500, this orange box started back in December of 2013, and as we know, we recently broke out of the box. What do the market wizards have to say about consolidation? The second item is something that Ed Sakota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. I find that major trends are now frequently preceded by a sharp price change in the opposite direction. Now we're zooming in on the weekly S&P 500 here. We have a sharp drop from late 2015 into mid-February of 2016. Then, near the Brexit referendum, we have another sharp drop. This is 1, 2, 3, 4 weeks where the market starts to plunge. What happened next? We got a sharp reversal in the other direction. And Randy McKay is telling us that often major trends come out of a situation like this, where you get sharp change in price action in the opposite direction prior to a move like this. Another quote from market wizards about that net aggregate opinion that we often talk about. Technical analysis reflects the vote of the entire marketplace and therefore does pick up unusual behavior. By definition, anything that creates a new chart pattern is something unusual. This here looks different than this here, here, or here. When something happens that looks different, we typically should pay attention, and the longer something like this holds, the more relevant it becomes. This type of reversal here after the Brexit referendum can be a little bit unnerving. Market wizards, as a trader who has seen a great deal and been in a lot of markets, there is nothing disconcerting to me about a price move out of a trading range that nobody understands. It may be difficult to understand what changed from this point here to this point here, but the reality is we really don't have to know the full answer to that question. Price and the market knows the full answer to that question, and the market wizards are telling us that it's not as uncommon as we might believe. Another comment on the subject: tight congestions in which a breakout occurs for reasons that nobody understands are usually a good risk-reward trade. Many were probably confused, and rightly so, in here during this reversal period. And fractals tell us that congestion could be on a 60-minute chart, a 1-minute chart, or a multiple-year chart as the one we're looking at now. This quote here is about the corn market, but it applies to the S&P 500 as well as many markets in 2016. If everybody believes there is no reason for corn to break out, and it suddenly does, the chances that there is an important underlying cause are much greater. Read between the lines. It's basically saying typically when something like this happens, there is a reason why it has happened, and we may not fully understand that reason until weeks, months, or even years later. As we said earlier, there's many ways to approach the markets and skin that risk management cat. Obviously, we're picking out quotes from these books that align with the way that we see the world, and we understand that that's not the only successful way to view the markets. I don't like to buy retracements. That basically says I don't like to wait for pullbacks. If the market is going up and I think I should be long, I'd rather buy when the market is strong than wait for a pullback. Buying on a pullback is one of those ploys that gives psychological satisfaction rather than providing any benefits in terms of increased profits. And here's the key. As a general rule, avoid those things that give you comfort. It's usually false comfort. does this apply to the present day? We know that we have a bullish breakout out of this box on the weekly chart. We're not going to hope that the market comes back down into this area. We're going to make decisions based on the facts that we have in hand as of August 11th and or August 12th. Market Wizards on opportunity cost. We would always cut back on what we thought were the least attractive positions in the portfolio. Remember last week when we went through the opportunity cost analysis comparing stocks SPY to bonds IEF. How does this quote apply to the present day? This is the S&P 500. These are the same weekly moving averages that we've been using in this video. This is as of Friday, August 12th at roughly noon Eastern time. You can see this is a full-bore bullish look in terms of the way our moving averages look. This is a bullish trend in favor of stocks relative to intermediate term treasuries. This is an opportunity cost analysis. Why? These are the same moving averages for IEF or intermediate term treasuries in isolation. Doesn't necessarily mean IEF is a bad thing to own. The question is there something that's potentially better? The math and the slope of these lines here is telling us to keep an open mind about the possibility of SPY continuing to outperform IEF. One of the reasons why we're rereading these books and one of the reasons why we chose this topic for this week's video is if we stay above these long-term trading ranges, it means we need to get refocused on trend following techniques, because we know the longer a market goes sideways, the bigger the move that we can expect from a probability perspective once we either get a breakout or breakdown. Well, the facts that we have in hand right now say we have successful bullish breakouts, and that's the case until the facts prove otherwise. Wizards. The basic concept that applies to both poker and option trading is that the primary object is not winning the most hands, but rather maximizing your gains. How might that possibly apply to our current portfolio and the breakouts from the boxes in 2016? The only way you can maximize your gains is to look the other way during inevitable and painful retracements when you have a big winner or a potential big winner in your portfolio. This is physical gold, $GLD. This is a bullish turn. We get the bullish moving average crossover on the weekly chart here in the year 2001. And you can see gold moved all the way from roughly 275 over 600 here. This is the type of big winner and long-term trend that makes trend following work so well. We often use the expression listening to the market wizards on that topic. Someone can spend millions of dollars developing an elaborate interest rate forecasting model. And I'll bet you that over the long run, the bond market's forecast will be better. Moral of the story, the general principle is that if you give up your ego and listen to what the markets are telling you, you can have a huge source of information. What is the present-day market telling us in 2016 about interest rates? Obviously, there are numerous ways to answer that question. Two ways to help us do that is to monitor bonds and to monitor interest rate sensitive and dividend paying REITs. If the market felt like the Fed was going to raise rates numerous times, it is unlikely that the weekly trend of TLT would look so strong on Friday, August 12th at 1:21 p.m. Eastern. Similarly, REITs, same situation, has bond-like characteristics because it's a dividend payer. We have a strong bullish trend in hand right now. It doesn't tell us anything about the future. It just tells us what the market is thinking today. Here's another example of the longer a market goes sideways or the longer people tell you that trend following doesn't work, The bigger the move that you can expect to get once a successful breakout occurs, the longer you're frustrated running a trend-following model, the more disciplined you remain, the greater the potential reward when a stock market, or any market for that matter, breaks out. What do the market wizards say about boxes and subsequent rallies that might help us in 2016? A move, so this is a move here, this green line, followed by a sideways range. Here's a sideways range. Often precedes another move of almost equal extent in the same direction of the original move. We get a sideways range here, a move that lasts 3 years in the S&P 500, another sideways range, and then another move of almost equal extent in the same direction. So basically what he's saying, when you get a move like this and consolidation, often if you break in the same direction, the move that you get after this period of consolidation matches in some shape, form, or manner, either time or magnitude, this move. 3-year rally, consolidation, 3-year rally. Notice this market wizard is using the term often, which means he's not talking in absolutes, he's speaking in probabilities. How might this concept that is outlined in Covell's trend-following book help us in the present day? Now we're looking at the S&P 500 weekly. This is 2011 where my cursor is here. This is the present day. A move, here's a move, followed by a sideways range. A move followed by a sideways range often precedes another move of almost equal extent in the same direction. A move, sideways range. If this quote holds, we would expect to see a move similar in duration to this move here. Now, it depends how you measure the move. You could say it was 3 years from the bottom to the top, or you could say we had a strong rally for 1 year in between the two boxes. If this quote held in the present day, and obviously there's a qualifier, there's an if there, it means we might see a rally that lasts anywhere from 1 to 3 years in this direction that looks similar to this rally here. This basic concept appears numerous times in these types of books, and we really want to drive the point home. Perhaps the most important rule is to hold on to your winners and cut your losers. Both are equally important. If you don't stay with your winners, you are not going to be able to pay for the losers. When gold moves from 275 to over 600, it allows you to cover a lot of relatively small losses. If you don't let your winners ride, it's going to be very, very difficult to cover those small losses. Shifting gears back to the wisdom of crowds, groups are remarkably intelligent and are often smarter than the smartest people in the group. Groups do not need to be dominated by exceptionally intelligent people in order to be smart. Even if most of the people within the group are not especially well-informed or rational, it can still reach a collectively wise decision. Think about that within the context of the data that we have in hand, and the S&P 500 monthly in a box on June 30th, and for some reason, the collective or net aggregate opinion has now decided that we should have a bullish breakout above the box. When the data improves, we pay attention to it and we allocate accordingly. Here's one example. S&P 500 daily, June 27th, price is below the 200-day moving average in red and below the 50-day moving average. If we fast forward to July 22nd, we have a radically different picture. Resistance, all in here. Resistance, couldn't clear it. Resistance, resistance. Now we have something that looks different. We have a bullish breakout. What do the market wizards say about a look like this morphing into something that looks radically different in a very short period of time? A good trader can't be rigid. If you can find somebody who is really open to seeing anything, then you have found the raw ingredient of a good trader. In CCM's terminology, this is your maximum flexibility 100% of the time. And that includes maximum flexibility relative to what happens after Friday, August 12th. It could be bullish, it could be bearish. Whatever the data says we need to do, we will do it. This is from one of the interviews in Market Wizard's question to the Market Wizard. What is the biggest public fallacy about market behavior? Answer: that markets are supposed to make sense. The data is the data, and the trends are the trends, especially in the short run. Sometimes it doesn't make sense. We have to be disciplined enough to follow our rules and allocate accordingly based on the new information, which dovetails nicely into this Market Wizard's quote. The second thing we do at Mint is that we always follow the trends and we never deviate from our methods. How does this quote help us in 2016? And more importantly, how does it help us going forward? Stocks weekly, bonds weekly, gold weekly, all as of August 12th, 2016. We always follow the trends. This is a bullish trend, this is a bullish trend, this is a bullish trend. And we never deviate from our methods. Therefore, going forward, if the math, the models, and the rules tell us that we have volatility to ignore, we're going to have to let our positions swing so we can stay with the longer term trends. Conversely, if these trends change, then we cannot deviate from our methods and we will have to take action. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.